Throughout the time, Warren Buffett has predicted a lot of movement in our economy. The question is, how does he do it? Does he have privileged information that we don't have? Does he manipulate the market with his buying power? Let's dive into this. Throughout his career spanning over 7 decades, Warren Buffett has demonstrated an uncanny ability to sense danger in the markets before many others. Let's examine some of his most notable warnings. In October 1987, just before Black Monday when markets dropped 22% in a single day, Buffett had been selling stocks and building cash. When the crash happened, he was prepared to buy. In the late 1990s, while others were caught up in dot-com euphoria, Buffett famously avoided technology stocks, a move criticized at the time but vindicated when the bubble burst in 2000. Buffett doesn't try to time markets, but he does pay close attention to certain indicators of market overvaluation. Let's explore the metrics he watches most closely. First, the market cap to GDP ratio, often called the Buffett Indicator. Buffett has stated that this ratio is probably the best single measure of where valuations stand at any given moment. When this indicator is high, Buffett becomes cautious. All that this is telling us is that the markets are overvalued and that they can move from extremes to extremes. Buffett has often said that interest rates act as gravity for asset prices. When rates are low, asset valuations can soar higher. When rates rise, valuations tend to fall. This is explained by multiple factors, but mainly the fact that higher interest rates increase borrowing costs for companies, potentially reducing their profitability and growth prospects, which can lead to lower stock valuations. Also, as interest rates climb, fixed income investments like bonds offer more attractive returns, leading investors to shift funds away from equities, thereby decreasing stock prices. We can also see that the interest rate had went up by a lot before the Great Recession and that they had went up again to 4.50% in 2025. We know that the past performance is not an indicator of future success, but it's a tool that we can use to prevent future crashes. One of the clearest signals of Buffett's market outlook is Berkshire Hathaway's cash position. When Buffett struggles to find attractive investments, cash builds up. Before the 2000 dot-com crash, Berkshire's cash grew substantially. Before the 2008 financial crisis, the pattern repeated, and in recent years we've seen Berkshire's cash reach unprecedented levels. By mid-2023, Berkshire was sitting on approximately $147 billion in cash, near its all-time high. This massive cash position raised questions about Buffett's view of current market valuations. While Buffett doesn't make explicit market predictions, his actions speak volumes. His willingness to hold enormous amounts of cash, despite his famous quote that cash is a terrible long-term asset, indicates caution about current valuations. And it's true. Why would an investing fund have $147 billion in cash? Examining Berkshire's recent investment activity provides further insight into Buffett's current thinking. In 2020 to 2021, during pandemic market volatility, Buffett was notably cautious. While markets recovered quickly, Berkshire was a net seller of stocks for several quarters, particularly reducing bank holdings and airline stocks. In 2022, with markets declining, Buffett became more active. Berkshire made significant investments in Occidental Petroleum, increased its stake in Apple, and purchased large blocks of HP stock. So what about now? Like Warren Buffett said, be fearful when others are greedy, and greedy when others are fearful. When everyone is optimistic, he becomes cautious. When panic sets in, he finds opportunities. And right now is probably the biggest opportunity of generational wealth. Sadly, the market is currently being manipulated by a macroeconomic factor, Donald Trump. But we will talk about this in another video. Remember, nobody, not even Warren Buffett, can predict the future. Warren Buffett's approach to market downturns isn't about making precise predictions. It's about preparation, patience, and focus on fundamentals. As he wrote in his 2016 shareholder letter, "Every decade or so, dark clouds will fill the economic skies, and they will briefly rain gold. When downpours of that sort occur, it's imperative that we rush outdoors carrying wash tubs, not teaspoons. Prepare your wash tubs.